Welcome to the debate from GiltEdge.uk. Before we begin, this content is for informational purposes only and does not constitute financial advice. Always do your own research and consider seeking independent financial advice before making any investment decisions. Your capital is at risk. Today, The Guardian and The Challenger go head-to-head on overpaying your mortgage saves you £47,000 in interest. No fund manager on earth can guarantee that. Let's get into it.
Let me start with a simple fact. If you overpay £300 a month on a typical £200,000 mortgage at 5.5%, you save £47,000 in interest and cut 7 years off your term. That's a guaranteed, tax-free, risk-free return. Find me a fund manager who can promise that.
I'll do better than find you a fund manager. I'll find you basic maths. That same £300 a month in a global equity tracker inside an ISA grows to roughly £228,000 over 25 years. Tax-free. You're celebrating saving £47,000 while leaving £181,000 on the table.
Grows to £228,000, assuming what? 8% annualized returns for a quarter of a century with no interruptions. That's not a plan, that's a prayer.
It's not a prayer. It's what global equities have actually delivered over every rolling 25-year period in modern history. The FTSE 100 alone returned 21% last year.
And the year before? And 2022? Cherry-picking one good year is exactly what the investment industry does to sell products. Markets crash. Mortgage overpayments don't.
Of course markets crash, that's the entire point of a 25-year time horizon. You ride through the crashes. Nobody investing £300 a month is checking their portfolio during a dip and selling, they're buying more units at a discount.
You say that, but people absolutely do panic sell. Exposed Investor found that the average retail investor underperforms the funds they're invested in by nearly 2% a year because of behavioral mistakes. Your theoretical returns aren't real-world returns.
So your argument isn't that overpaying is mathematically better, it's that people are too emotional to invest properly?
Partly, yes. And there's nothing wrong with acknowledging that. The psychological return of watching your mortgage balance drop is real. Sleeping well at night has a value that doesn't show up on a spreadsheet.
I agree that peace of mind matters. But you know what else helps you sleep at night? Having £50,000 in liquid investments you can access in 48 hours if you lose your job, rather than equity trapped in your house that you can't touch without remortgaging.
That's a fair point on liquidity, I'll give you that. But let's talk about what 5.5% guaranteed actually means. You don't pay tax on it. You don't pay fund fees on it. There's no platform charge. The effective pre-tax equivalent is closer to 7 or 8% for a higher rate taxpayer.
Except your mortgage rate isn't 5.5%, not really. That's today's rate. When your fix ends in 2 or 3 years, you'll remortgage, and rates could be lower. The Bank of England is expected to cut further. You might be overpaying against a rate that doesn't exist anymore.
Or rates could go higher. Nobody predicted the spike to 6% in 2023. The point is, overpaying now at 5.5% locks in that return regardless of what happens next.
But you're comparing a fixed 2-year return against a 25-year investment horizon. That's apples and oranges. The relevant question is, what's the average mortgage rate you'll pay over the full term? And historically, that's closer to 3.5 or 4%.
Even at 4%, a guaranteed tax-free return beats cash savings and comes very close to matching long-term equity returns once you account for fees, taxes, and the behavioral gap we just talked about.
It comes close if you're investing badly, sure. But inside an ISA, there are no taxes on gains or dividends. A global tracker charges 0.1% in fees. You're overstating the drag.
I'm not overstating it, I'm accounting for reality. How many people actually hold a low-cost global tracker for 25 years without tinkering, switching funds, or timing the market? Almost nobody.
Then the answer is better financial education, not giving up on investing entirely. You don't solve behavioral mistakes by avoiding the best wealth-building tool available to ordinary people.
The best wealth-building tool available to ordinary people is their home. Owning it outright, 7 years early, with no debt hanging over you, that changes your life in ways a brokerage balance doesn't.
It changes your life, but it doesn't maximize your wealth. And let's be honest about what debt-free actually means here. A mortgage at 5.5% when inflation is running at 3 or 4% means your real borrowing cost is under 2%. You're rushing to pay off cheap debt.
Cheap debt is still debt. And people don't experience inflation as a discount on their mortgage, they experience it as higher food and energy bills. The real-world feeling of owing £200,000 is not reduced by CPI figures.
Again, you're making the emotional argument. Which is fine, just don't dress it up as maths.
The maths works too, in plenty of scenarios. If your mortgage rate is above 5%, you're in a higher tax bracket, and you have no emergency fund built up yet, overpaying is objectively the right move before investing a penny.
I actually agree with that. If you've got no emergency fund, you shouldn't be investing or overpaying, you should be building a cash buffer first. But once that's in place, the ISA wins over a 15-plus year horizon by 6 figures.
Wins on average. Loses in the worst case. And people live in the worst case, they don't live in the average.
Over 25 years of regular monthly investing, the worst case for global equities has still been positive. There is number 25-year period where a diversified investor lost money. The worst case is just a smaller win.
A smaller win that might not beat the mortgage rate after fees and mistakes. Look, I think we actually agree on more than it seems. For disciplined investors with a long horizon and an emergency fund, investing can make sense. But that's not most people.
And I'll concede that for someone with a high mortgage rate, a short remaining term, or genuine anxiety about debt, overpaying is a perfectly rational choice. It's just not the optimal one for wealth building.
Here's my final point. £47,000 saved in interest is real money in your pocket, guaranteed, with zero risk. In a world full of uncertainty, that's worth more than any projection on a screen.
And mine, over 25 years, the disciplined investor ends up roughly £126,000 better off, even after accounting for the earlier mortgage payoff. Optimizing for certainty is a luxury, and it's one that costs 6 figures.
The Guardian, The Challenger, thank you both. What do you think? Let us know in the comments. Read both articles in full at gilt-edge.uk. Thanks for listening to the debate.